Welcome to the Explainer. So let's just jump right into this. Picture this. You're finally selling your business, and you get that massive, life-changing number sitting right there on a term sheet. It feels like the ultimate win, right? But what if I told you that the big, shiny number on that contract is definitely not what ends up in your bank account? Today, we're unpacking a hidden financial mechanism that can literally quietly drain your hard-earned wealth right at the finish line. It's an accounting process called purchase price allocation. And look, if you aren't prepared for it, it is a massive tax trap. So, you might be wondering, does that headline price actually matter? Well, yeah, for sure it matters, but it's really only half the story. It is so incredibly common for owners to fight tooth and nail for that top-line sale price, win that battle, and then somehow still lose out on their actual after-tax proceeds. And why does that happen? Because the headline price doesn't actually dictate your tax bill. How that price gets carved up, that's what dictates the bill. Section 1. Beyond the headline price. To really wrap our heads around this trap, we kind of have to change how we think about selling a business. You're not just handing over one single giant box wrapped in a bow. On paper, especially in an asset sale, the buyer is actually buying a whole bundle of individual items. Think of it like a basket. This business bundle includes your inventory and receivables, your equipment, fixtures, and vehicles, any patents or trademarks you might hold, and of course, your customer relationships and goodwill. You're selling a basket of very distinct asset categories, and each one has its own specific value. Which brings us to purchase price allocation. Basically, this is just the process of how you split that total sale price across those different asset categories we just mentioned. I know, it sounds like some boring late-stage accounting homework, right? The kind of thing you just hand off to the lawyers after the handshakes are done. But as our source material from Dream Business Brokers makes crystal clear, treating this like a simple administrative chore is a massive financial mistake. Section 2. The tax trap. Goodwill versus equipment.
Okay, here's exactly where your negotiated price and your tax liabilities dangerously collide. Turns out there is a massive built-in conflict of interest happening here. See, the seller, that's you prefer a high goodwill value to protect your after-tax proceeds. But the buyer? They prefer a high equipment and intangibles value to create future tax deductions for themselves. They want to maximize their future write-offs, while you just want to minimize your immediate tax hit. It's a tug-of-war, and you're both pulling in completely opposite directions on the exact same pool of money.
So why is equipment so uniquely dangerous for the seller? Well, it all boils down to something called depreciation recapture. Think of it as a pay-it-back mechanism that's baked right into the tax code. If you've owned your equipment for years, you've probably taken tax deductions on it as it depreciated over time. Well, when you go to sell that equipment as part of a deal, the IRS wants some, or honestly, sometimes all, of that tax benefit back. That gain gets taxed as ordinary income, which is usually at a way higher rate. So, if the purchase price is heavily allocated to equipment, it's going to seriously hurt the seller right there at the closing table. But now, look at the alternative, goodwill. Goodwill is defined as the going concern value of a business. It's the intangible stuff. It encompasses your brand, your relationships, your operating know-how, and your future earnings power. For you as the seller, allocating more of the purchase price to goodwill is generally fantastic for your tax math. Why? Because it's typically treated as selling an intangible capital asset, meaning you completely sidestep that painful bite of depreciation recapture. Section 3. Behind the scenes with the IRS. Now, I know what you're thinking. Great, I'll just put 99% of the sale into goodwill. Yeah, unfortunately, you and the buyer can't just make up these numbers out of thin air. This whole thing is governed by strict government rules, specifically Section 1060 of the tax code. Here's the official IRS rule. The allocation follows a residual approach. You allocate value across asset categories, and whatever is left over is treated as goodwill. Basically, you have to assign fair market values to all the hard assets first, the inventory, the machinery, and only the leftover or the residual amount is legally allowed to be categorized as that tax-friendly goodwill. And just to make sure everyone's playing by the rules, the IRS double-checks your math using Form 8594. This is the required asset acquisition statement used by both buyers and sellers to report the sale. The absolutely crucial takeaway here, both parties have to report the exact same allocations to the IRS using this form. I mean, think about it. If the buyer tells the IRS the equipment was worth $500,000 and you file saying it was worth $50,000, yeah, that's going to trigger a massive problem. This is exactly why getting early agreement on these numbers is non-negotiable. Quick little geographical detour here. Let's call it the California twist. If you're doing business out in California, the state actually taxes capital gains as ordinary income. There is no preferential lower rate at the state level. Bummer, I know. But hey, do not let that trick you into thinking allocation doesn't matter out there. Federal tax differences are still very real, and those federal characters will still heavily dictate your deal outcomes, the timing, and all the reporting complexity.
Section 4. Real-world deal math.
All right, let's take all these abstract accounting concepts and plug them into a real-world scenario so we can really see the impact. Imagine you're selling a manufacturing or distribution business, and boom, you've negotiated a phenomenal headline purchase price of $3 million. You are thrilled. The handshakes are done. The $3 million is locked in. But then the allocation schedule arrives. Using that residual method we just talked about, let's see how that $3 million might actually get distributed. We've got $250,000 allocated to inventory. $600,000 goes to equipment and vehicles. Another $350,000 to intangibles. And finally, the leftover amount, our residual goodwill, comes out to $1,800,000. Add it all up, and it totals perfectly to your $3 million headline price.
Okay, here's where the trap literally snaps shut. Shifting just $300,000 from goodwill over to equipment changes the entire tax character of what's being sold without altering the headline price one bit. If a buyer pushes you to value the equipment at $900,000 instead of $600,000, and they reduce the goodwill by that exact same amount, the total is still $3 million. But suddenly, you have an extra $300,000 subject to higher ordinary income tax rates because of depreciation recapture. The buyer gets amazing future deductions, and you just quietly lost a massive chunk of your actual take-home net proceeds.
Section 5. The Seller Playbook. So how do we defend against this? You need a playbook. Here are the 4 critical, actionable steps every owner needs to take. Step 1. Model your net proceeds early. Seriously, don't just compare offers based on the big headline price. Compare them on your after-tax proceeds using a few different allocation scenarios. Step 2. Bring your CPA in before the terms are locked. Don't wait until the finish line. Step 3. Review those allocation schedules meticulously. And Step 4. Ensure Form 8594 consistency. Your deal team absolutely has to make sure the paperwork matches your expectations long before you sign any definitive agreement.
And hey, please pay super close attention to this next part. Do not let equipment-heavy allocations get buried in the purchase agreement schedules as just boilerplate language. It is crazy how common it is for owners to spend all their time agonizing over the main body of the contract, and they just treat the attached schedules as legal fluff. But that schedule might have a quiet little sentence saying, "The parties agree to allocate purchase price as follows," followed by numbers that brutally shift value into categories that are incredibly expensive for you.
Now, if you do catch a buyer being overly aggressive with their allocation requests, you are not defenseless. You have ethical negotiation levers you can pull. If they insist on a tax structure that hits you hard, well, you can counter by adjusting the overall purchase price upwards to offset your tax hit. Or you can modify the escrow size in the release schedule. You can revisit earnout terms, or even limit the scope of the reps and warranties. This is a real game changer, especially when you have multiple buyers at the table. You can leverage these deal points against each other so you don't get cornered.
Well, we've covered a ton of ground today on a topic that honestly rarely gets the spotlight it deserves, so I'll leave you with this final, provocative question. If you sold your business tomorrow, how much of that headline price would you actually get to keep? Don't let your exit strategy end at the handshake, right? Understand the math, bring in your advisors early, and make absolutely sure the wealth you've built actually makes it into your pocket. Thanks so much for joining me on this explainer, and we'll see you next time.